Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Drew Meredith, welcome back to the show, mate.
Thank you. First time in person?
Yeah, it's first time ever. So we've been doing podcasts for a couple of years. Yeah, and we're recording in the office, which is nice.
Yeah.
So if you are watching on YouTube, g'day. Hopefully we'll have you back too for the reporting season where we do some of the weekly shows and we talk about companies. That'll be heaps of fun. They'll come up in August. But right now we're talking about Australian equities ETFs. So the most popular names include VAS or ticker symbols, the A200 ETF, MVW, which is a VanEck equal weight. We've got STW, and I might just throw IOZ in here. It's just like a little one on the side as well. But it's not little, it's $4.5 billion. So we're talking about ETFs, super popular topic because people think of ETFs, particularly in Aussie equities, for their core of their portfolios. For those that aren't familiar with what you do, mate, you're obviously a CFP, financial planner, every day.
SMSF Association.
Yeah. You do it all.
Everything.
Right,
so, a lot of content.
Yeah, a lot of content for Inside Advisor, Inside Network. You do the daily report on Rask Media. You have two different variations of portfolios that you construct for clients, right? You've got like a light version and then you've got like the fully sophisticated version as well.
Yeah.
Can you explain how those two work?
They both work on the same concept of, strategic asset allocation is the most powerful driver of returns over the long term.
Mm-hmm.
The difference between the two is one is fully implementable on the ASX and the other requires platforms, includes managed funds. And I mean, you initially probably thought it would be cost driven, why you'd use ETFs versus managed fund. But it was almost the ease of implementation, being able to service and offer that to younger clients who are probably more comfortable with the volatility that came with it as well.
Yeah, right.
But essentially identical. You're just looking for a different instrument to implement each position or idea.
So basically you've got two different streams that clients could go into. One is full of ETFs and the other one has ETFs, but it also has other things like managed funds through the platform.
They're actually kind of merging together at the moment. I think we were
Right.
talking earlier this week with the consultants we use that bringing more of that lower cost core into our active portfolio at the same time. So historically it was 100% passive with the active decisions being asset allocation driven versus 100% active in the managed fund model.
Yep.
But definitely, they're going to look very similar, I think, over the next 12 or 18 months.
So this is an interesting point because a lot of the conversations that you have with advisors and even individual investors is it seems to be evolving in some ways. So from my point of view, we see like lots of advisors moving the core of their portfolio to things like we're about to talk about, whereas it's like low cost asset allocation is driving returns. Let's go for low cost, like transparency with the portfolios. Are you seeing that as well?
Yeah, I think it's difficult when you've got a portfolio in place to keep thinking about it as a blank sheet of paper. But if you have a blank sheet of paper, you have to think about what you're trying to achieve. And generally that's, 2 to 3% above the benchmark, whether that's the ASX 200 or the MSCI. But how do you achieve that without first getting the benchmark? And probably 2022 has been the most interesting where markets have fallen and been so volatile. Just getting the benchmark is difficult. So I think more and more people are understanding that you can have a low cost core, you can keep the end costs down to your clients and investors because costs are important. And then you use that, what we call a fee budget, to take active risk and try to get that 2 to 3% outperformance.
So how do you, I know we're going to get onto ETFs in just a second, but so the fee budget, that sounds interesting. So effectively you're trying to keep the fees for the portfolio capped for your clients.
Yeah.
So you can take costs out where you can, and then that gives you the scope to allocate fees to say active funds or whatever. Where do you typically find most of the fees going?
Most of the fees, I mean, if you look at the way pension funds work, and they've probably been doing it for the longest, they have a low cost or internal core, so ASX, MSCI, global equities, and they spend all their fee budget on private market assets, so unlisted infrastructure, venture capital. I think the majority of advised portfolios spend all the fee budget on active fund managers, whether that's global equities or Australian equities.
Yeah, right.
And we look at these, you'll pay 10 basis points for an ASX 200, but an active manager for the same kind of index would be closer to 1%.
Yeah, right. Okay, and just final question on this then, do you find that when you speak with active managers that you have any type of scope to ask them to reduce fees?
Yeah, I think it's an important role of an advisor. And working with an advisor, they're able to not necessarily pull, but negotiate with managers using the assets that they manage. So we can generally, obviously the bigger you are, the more discount you can get, but we can generally negotiate.
Yeah, right. Okay. So there was one question that I had on the topic of Aussie equity ETFs, which was at the end, but maybe we can bring it up to the top of the show. Or do you want me to do it?
No, it's all good.
Yeah. Okay. Because I think this kind of sets the scene for then how do you get the expression, which is if we think about a portfolio, most people that listen to this probably follow some type of like core or satellite type of exposure where they have the low cost core exposed to the key markets. Yeah. And then they have, like you said, in terms of your fee budget, they might think about it like as a tactical or a satellite allocation where they're like, I'm going to go for active here, thematic there, unlisted assets here, whatever. How much would you consider to be reasonable for an allocation to Aussie equities, however you think about that? So whether it's active or passive, for say someone that's 30 versus someone that's 60, like just to put some context around this.
As we'll go into this, we'll talk about how the nature of the ASX 200 isn't that diversified. It's half of it's in two sectors. Yeah. So naturally, the index should be more volatile than active managers. Our view generally is that younger people with longer term investment horizons can allow compounding to happen over a longer period and invest more. So they'd naturally be able to hold more in that passive core or that low cost index core. Yep. Now we'd probably start at depending on, most fee budgets start about what Australian superchargers, to be completely honest. That's like 70 basis points. Yep. So if you work from there, you can usually have about 40 to 50% in low cost before and then have plenty of fee budget to get up to 60 or 70 basis points with active management. That
makes sense. And how about then, for someone like, one of the ways that I know, so like a pre-retiree or just going into retirement type of client thinks about things is they really only care about their portfolio allocation 3 years out from retirement and then 3 years after retirement. And then they kind of give it up and say to an advisor, can you do it for me? When they come to you at that age, do they come with what you would consider a reasonable mix and asset allocation? So I'm thinking like 20% Aussie equities, 30% Aussie equities, I don't know, something like that.
Most people come to us with no strategy. Right. Just a collection of assets that have been put together over decades. Even, some stock portfolios that people have been building them themselves, they might have 40 different holdings and are really building an index fund.
Building their own index without knowing it.
And just spending a lot of time thinking about it. So most people don't have a lot of strategy. There's always a lot of overlap. And, one of the most important things we have is you have an investment policy that even if it's on 2 pages, guides every investment decision. And part of that is talking about how much you want in passive and how much you want in active at any given time. So valuations are important. So you can buy the ASX about 14 times PE. I know it's backward looking, but
it works.
That's reasonably cheap. If the Aussie PE was close to 20 times, you'd probably think about having less in passive if you're worried about the valuation of the entire index. So.
Okay, interesting. All right, so let's talk about Aussie equity ETFs. And we've got a collection of 4 or 5 here, the biggest. The biggest by far is the Vanguard VAS ETF. That's as of the end of April. This is using ASX data. April 2022, it had $11 billion in it. So can you tell us a little bit about this ETF, what it does, if you like it, if you don't?
Yep. Probably the most straightforward. Replicates the ASX or the S&P ASX 300. for the specific name, isn't it?
Yeah.
You always have to put that in.
For sure.
Which is small, mid, and large caps. So, small caps generally under 300 or 400 million.
Yep.
Mid caps, anything up to a couple of billion. And then large caps, everyone knows the top 20.
Mm-hmm.
I mean, Vanguard is just like the original innovator in financial services. I'm sure you've done a few on them before. They got 7 trillion, almost all in index strategies like this. Market cap weighted, so it only just invests into each company on size, charges 10 basis points. So that's 0.1% for the index replication. And I mean, the reason for the low cost, similar to what the other ones we'll talk about, is that the concept of Vanguard is that as more money goes into the funds, the fees go down in kind of unison with that. So that's why they track towards zero. And that's why they've got 7 trillion in US dollars.
Well, that's what we were talking before this morning when we were caught up. It's kind of unique amongst the providers because they are deliberately lowering that cost. I remember a couple of years ago, I think it was 15 basis points. Now it's 10.
Yeah.
And while that doesn't seem like a lot, it's actually, a third coming off it. So it's quite a big fall in a few years.
Yeah, definitely.
In terms of the fee. So that's good. So you would expect, I guess over time, you'd expect it to keep falling, maybe not to zero, but.
We'll go close to zero.
Yeah.
And I think it's a trend, ETFs are kind of causing it in the active management space as well, where, if you have scale, you probably need to be pushing your fees lower.
Yeah.
And ETFs are just forcing it by giving people an alternative.
Yeah.
And I think someone quoted the other day, which was the fact that financial services or investment is the only industry where you can get the average for free, essentially. So you can get the benchmark without paying nearly anything for it, where you can't go to a doctor and get an average doctor for nothing.
Yeah, that's it. And I think it was Kev from Atchison.
Yeah.
So and that's the thing, right? Like, we talk about this a lot in investing. It's like long-term investing, 10, 20 years. And if you just look at the longevity of the passive strategies, they're the ones that have performed consistently over a very long period of time, at least when it comes to these types of products. So for investors sitting back thinking, well, I am investing for 10 or 20 years, these types of products like VAS, it's easy to see why they're so popular because we've seen the studies from SPDR and all those places, how effective they are. Maybe this is an interesting segue then into the next one. If just off the top of your head, this is a bit of a pop quiz, so I'm putting you on the spot. Now, the BetaShares A200 ETF is very, very similar to the Vanguard ETF, the VAS, but it only has 200 companies in it, right?
Yeah.
Now, I'm going to ask you, over the last 5 years, if we looked at the standard deviation of VAS versus the standard deviation over the last 3 years of BetaShares, which one do you think is more volatile?
The ASX 300 should be, because it's holding small caps.
Yeah, see, this is the thing. Over 3 years, the BetaShares A200 has 17, we're measuring vol in 17.65%, but Vanguard is 14.86%. So it's interesting, fewer holdings, but the shorter time horizon shows you more volatility, which makes sense. We've been through COVID. Yeah. We've been through recent times as well. When you look at ETFs, because this ETF, A200, BetaShares follows the selective index, which is a cheaper index, as far as I'm aware, allows it to drive down costs. When you look at ETFs, do you pay as much attention to the track record for these passive ETFs as you would for an active fund? Like I was saying, some advisors, or at least in researchers' history, they would go 3 years. If you don't have a 3-year track record, we don't want to talk to you.
Yeah.
Would you say the same thing for ETFs and passive ETFs at that?
No, I mean, as long as it's tracking the index and within, after fees, it's in line.
Mm-hmm.
I think that's the only thing that matters when you're buying an ETF.
Yeah.
And you tracking the history is just telling you what the index has done for the last 3 years. So you probably want to view on the future when you're allocating, as in, do you expect the ASX to keep delivering those returns over the next 10 years? Yeah,
right. Okay. So here's another metric that we talk about when it comes to index funds and index ETFs, and ETFs in general, but in particular these two types, like the index and ETFs, is tracking error.
Yep.
So that's the difference between what the index is doing that they're supposed to be tracking and the fund itself.
Yep.
How much attention do you pay to that? And has your view on that changed over time?
We probably pay more on active.
Okay.
Because that's where, if you're paying an active fee, you want higher tracking error, because tracking error essentially is the only driver of getting active returns.
Yep.
I think you have to pay attention to it. I think when they're this size and they've got 4, 5 billion, billion plus, they're kind of proven, and your tracking error is always should be incredibly small. For probably, I'm not sure if you got it there, zeros, put 0.
I don't have it in front of me, but it would be tiny.
It should be very, very small. Although, some of the indexes, obviously you can't hold every single stock and index at the exact percentage every single day. So there is always going to be a little bit of differentiation. Mm-hmm. But I think you always keep an eye on it when you're doing that initial due diligence process. Do you want ASX 200? Do you want ASX 300? Is it providing a full, replication of the benchmark you want? But unless it's a kind of a new strategy, you should be pretty clear. Yeah, I think that's the thing. Yeah, so for those of you who don't know what we're talking about, this is the difference between the benchmark and the fund assets. Typically, what we see is when a fund is newer, it tends to have a bit more tracking error. It tends to be a bit more all over the place. And you do see that settle over time as the fund grows and market makers do their thing and so on and so forth. So for the VAS ETF, I just had the data here in front of me. Since inception, the NAV is up 9.51% per year and the benchmark is up 9.63. So what's that? 8 basis points a year. Yeah. Tracking error. So it's really, at the end of the day, we're splitting hairs here. Most investors would look at this and be like, I wouldn't. Yeah, it's pretty close. Yeah, it's pretty close. It's good. It's a rounding error. Yeah. But it's something that researchers I know think a lot about. The other ETF here, Drew, is the STW ETF. This comes from Spider, 4.8 billion, 13 basis points or 0.13%. What does this ETF do? So State Street's the junior from Vanguard. Probably too hard to say that. They got 4 trillion versus 7 trillion. And then BlackRock's got 10 trillion or close to 10 trillion. Yep. It's very similar, just tracks the ASX 200 rather than the 300. So it cuts out that 200 to 300 group of companies that are usually small caps. And I like to look at what's at the bottom end of these indices. Yeah, I like that. So the bottom end of the ASX 200 is Codan, which I think is that metal detection and batteries. Blackmore's, City Chic and Tyro. And then at the bottom of the 300, they're all about $1 billion market cap. And then the bottom of the 300 is BWX, Redbubble and Nuix. I won't talk about Nuix. You know my backstory there. But they're about 200 million market cap. So really small cap companies versus still $1 billion market cap at the other end. So I'm going to do a bit of pop trivia again. So before I said Vanguard VAS over 5 years was 14.86% standard deviation here. What do you think STW is? Knowing that it's trimmed off that bottom 100, also over 5 years. I think it was 14 when I checked it last night. Yeah, so it's also 14. There's, in terms of the standard deviation of volatility here, it's very, very small. Yeah. So the difference is actually tiny. And that's probably due to the weightings of those 100 companies, right? Because it's market cap weighted, you got less in those, that 2 to 300 range. Yeah, and that should be where your volatility, and if you're taking more risk, that's where you should be getting more reward, but also more volatility with it. It's interesting though, right? Because I've also looked at just the returns at a high level. It's about 40 basis points different in the return over the last 3 years. Yep. Over the 5 year, it's about 30. So, this in terms of worse. Yeah. I'm not worse, but just slightly worse. Slightly worse. So STW being worse than Vanguard VAS. And just again, small numbers here, but over the long term, it can make a difference. Would you put that down to the small companies being a driver of growth over recent times? Yeah, if you've checked it in December, it probably would have been the opposite. If you read my daily, I always track the ASX 200 rather than the 300 or the All Ords. And just because really the client base we wouldn't touch anything outside the ASX 200 as a direct investment anyway. So that's our relevant benchmark, I think. Yeah, fair enough. And I think it'd be solely due to there's more risk of financial troubles and more cyclical companies, more small miners in that 2 to 300 range. Yeah. And you're really talking about, real semi-blue chips, if they're still possible to call things blue chips, in the ASX 200. Yeah, that's fair. Yeah, and that's fair because, and we see some of the ETFs target that 2 to 300 range as kind of like a small cap ETF or a mid to small cap ETF because that's where people don't have a lot of exposure because they do just have the standard 200.
And in Australia, that 200 to 300 range market cap company is actually quite small versus overseas, where that would be still massive by our standard.
Yeah, a global small cap or a global SMID, as they call them, is anywhere from like 2 to 5 billion, and Aussie small is 200 million, so 10 times smaller. And
also the other thing is, if you don't know how indexes are constructed or indices are constructed or even the ETFs, it's actually quite hard to track true small and micro caps in Australia because of how illiquid they are. To buy and sell them as an ETF is very hard. So that's why a lot of them don't do full replication. Yeah. They do that synthetic exposure to the underlying index. And the SPDR scorecard always shows, I think, that smaller companies, managers or active managers in smaller companies tend to do better than the index because there are so many illiquids and that liquidity premium. And so this is, like when you go into those darker pools, that's where the active tends to be better. And we see that overseas as well with emerging markets, equities managers as well. Okay, so maybe we can just both riff on this next one because this is probably the most different of all of them, but it's very popular in Australian equities, which is the VanEck MVW Equal Weight ETF. When I pulled the numbers this morning, just straight from the VanEck website, it had 89 holdings. So all of these other ETFs that we're talking about have 200 or plus. It's got a higher fee load at 0.35%, which is somewhat standard for the VanEck range of ETFs. So it's an equal weight ETF. And I do have some data here in front of me. Again, just pulling this from today. Is that against the 200? 100. What was that? Equal weighting of ASX 100 stocks. That is a good question. I think it's at 100. Yeah. And I've got the sector allocations here. So in terms of sector weightings, the big play for this one is basically if you have a market, and I was reading the white paper for this, if you have a market that is narrow and top heavy, equal weight can help because we are narrow in terms of we have a few companies, not that many companies, and we're top heavy and now we've got banks and resources at the very top. 54%. Yeah. So financials for this ETF make up 19% versus in the VAS ETF where it's in the plus 20% range. Yeah. And in terms of resources, we've got 18.8% here. So they're trying to wind that back, whereas say in the VAS ETF, it's 25% for materials. Yeah. So we're trying to wind back those two and then allocate elsewhere. We have fewer companies, and the top 10, if I just bring this up again, only make up like top 10. I think it's less than, I should have these numbers pre-prepared. I do not, Drew, sorry. But I think it's only like 20% of the portfolio. Yeah, so maybe about like between 1.5% and 2% in every exactly. Holding. I don't think anything is more than say 1.6. Yeah. So we're seeing here that they're trying to deliberately just allocate further down the market cap spectrum, probably to that 50 to 100 range. Yeah. Question you posed to me before we jumped on air was, is this an active decision to buy this ETF? Yeah. It is? I think it is. Why did you say that? I actually think you can put it next to a VAS or the other options as well because the sector allocations are so different in the stock allocations. You know, any decision that's not following the index or the market cap weighting is obviously going to be active. Yep. But I think it can be super powerful. We've had it in one of our ETF models for quite a while, and I mean particularly. Not saying the market's overvalued or anything at the moment, but when you've got two sectors making up 50% and both those are doing incredibly well at the moment, you know, CBA over 100, BHP, Rio, all these companies pumping out profits, well, buying the index, which has 20% less exposure to them, is a good diversifier. Yeah, it is. It is. And this is an ETF that often wins a lot of the awards for innovative ETF, unique exposure to Australian equities. So price earnings ratio of the ASX, as you said before, is 14, 14.6. Price earnings ratio of this ETF, the MVW ETF, is 15 times. The average or median market cap for MVW is 23 billion. For VAS, it's 44. So would you expect with this ETF more volatility or less volatility than the VAS ETF? I think it naturally has a higher mid-cap exposure or end of the 100 just because it's going to be equal weighted, so more volatility for sure. Am I going to be embarrassed again? No, you're right. So 16.1 versus 14.86 for VAS. So yes, it does. And that tells you how much that you expect the market to be, and that's a historical average, isn't it? Yeah, 16%. Yeah, that's how much you expect the market to move on a yearly basis. Yep. Yeah. Okay. And so next, this is another bit of trivia for you. So I'm comparing it to the VAS ETF because it is like the poster child. It's the biggest. I didn't know this was a test. Yeah. So this is ETFs 106, End of the first year. So here we go. Vanguard VAS return over 5 years, right, is 10.29% annualized. That's total return, 10.29. Do you reckon, given the volatility that we've had, this is the end of April 2022, would it be more or less than that? So for MVW, we've got 10.29 for VAS.
I think
it's a complete guess.
Yeah, I'm going to say it would have slightly underperformed, more so
interesting.
because of the last 4 months.
See, I would have guessed and said more, but you're right. It is 9.73, so 60 basis points lower. But the reason why I would have said more is for the last 5 years, it's done so well.
Yeah.
So I was surprised to see that it hadn't achieved that. So you mentioned before, and this is important, I think, for a lot of our listeners, is you said you might even compare this, because this is an active decision. It's a higher fee load at 0.35% as well.
Yeah.
Would you be setting I don't know if you use them, but like a large cap Aussie equities active manager against something like this?
Yeah, I think so. I mean, you can put you could put VAS next to it. You could put a high yield, like an income producing strategy next to it as well. Mm-hmm. But I think it works in an active or a passive portfolio because you're getting a lowish cost exposure to mid to large cap companies. So, and I mean, one thing we look at, and the Atchison guys look at, is when you put it next to each other, what does a portfolio actually look like? So if you plug in all the stock holdings in the VAS and next to this, it offers very different holdings. So you're removing your tilt towards materials within a bigger portfolio.
So could you then have, say, if you're building out your core with the likes of VAS, SCW, A200, IOZ, which is another one that we can talk about, could you then, if you're tilting back into Aussie equities for whatever reason, could you use MVW for that?
Yeah. I'd do it on a valuation basis, because you're taking, if you think banks are overdone or materials or what's next, healthcare, then you might tilt into these. Or if you think that the sectors that are underrepresented, like tech, consumer companies, then you might tilt into this at the given time. Okay,
interesting. So there's one more ETF which I'll mention on the end here. I didn't actually realize, but our producer off screen here, Monique, did buy this ETF.
You can't forget BlackRock.
Even though we didn't have a recommendation, Monique went ahead and did it anyway. Just said, here you go. So it's iShares, and by the way, it was a great purchase. So iShares ETF, IOZ, just a standard ASX 200, core holding. 9 basis points is the fee load. 4.5 billion in the fund. Comparable, obviously, on risk and return metrics to STW because it's the same. I don't know if you use this in models, IOZ.
No, we've tended to use the Vanguard historically.
Yeah. Okay. So these are probably the 5 preeminent equities ETFs here in Australia. So just to recap, we've got A200, we've got VAS, STW, MVW, and IOZ. There are many others, but there are ethical tilts on this. There are income tilts on this. There are active, obviously. There are so many different ways to play this. So historically, you just said you use VAS. Yeah, right. And what's the driving factor? Like, what's pushing you to VAS?
We were actually using VHY, which was the high income producing, so not VAS. And really, I think Vanguard's high yield strategy was one of the better ones. Yeah. So we've tended to keep that one, not VAS. Sorry.
Yeah. Okay. So VHY. Yeah, I've looked at that because with VHY, and I was in a bit of a debate about this the other day. VHY is another one that's focusing on high yield. Yeah. You occasionally can get yield traps in that because historically it was a bit blunt in terms of how it targeted yield. Yeah. But then it started bringing analyst consensus and it started to improve it. Like I remember a few years ago, when BHP cut its dividend? I think that was quite a big position and it didn't pay the full dividend. So people were disappointed. But that's actually really interesting because from tax effective point of view, VHY over VAS probably makes sense, because you're collecting dividends rather than paying out capital.
Yeah, I think your franking on VAS is only 80%. And I would say it's pretty much 100 in VHY without looking at it.
Yeah, I don't have the data off the top of my head either. This is a great podcast we should have had the data, but see the show notes. There's all links to the websites and the PDS, of course. So that's another one which we could talk maybe in another episode about factors and income-focused ETFs. But for the most part, the equity yield on these ETFs will be about 4 to 5%. You get franking credits as well. So you still need to hold them for the 45 days. You still need to be a long-term investor and all that, but you get all of that. For me, historically, just for disclosure, I own the A200 ETF in my portfolio. We had recommended it back in the day when all the other ETFs had higher fee loads, but now they've all come down. They're comparable to A200. There's a part of me now that if I had my time again, I probably would have gone with VAS, simply because if you're investing for 10 or 20 years and Vanguard's committed to lowering the fees, as your balance gets bigger, the fees come down. So unless BetaShares if you're listening, BetaShares, unless BetaShares want to lower their fees, there's probably a natural gravitation towards VAS.
Yeah.
I don't know if that's fair. Would you say it's fair or?
Yeah, I think so. I mean, we're not talking about much, are we? Like 0.03%, but it is important. And I think as you get more size, it'll keep going down anyway. They'll all probably sit at the same point at some point, but Vanguard's got 7 trillion and BetaShares, assume I can't remember 40 billion, 50 billion. So as they grow, I'm sure it'll come down. I mean, I'd probably go, I like the ASX 200 more than the 300. So the State Street, slightly more expensive, wasn't it? 13 bips.
Yep. Slightly more expensive. Like you said, you're probably splitting hairs at that type of fee.
For portfolio construction purposes, they're 200.
Yep. Okay. Interesting. I think there is a lot that we could go on here, like in terms of how we could take this conversation to other places, like in terms of where we go down to thematics, which are more interesting, but often, they're not always reliable, the thematic ETFs. So you have to be careful there. But for building out a core, I think this is a great discussion around the options that are available to people. I had one question to you, which was just around the issuer of an ETF provider, or like the ETF provider themselves. You mentioned that Vanguard has this much under the assets under management. BetaShares has this much. In the core of a portfolio, and maybe I'm thinking about the Wattle Partners like ETF model that you got, does the issuer play a big part in that? Or
it's probably more about liquidity. We don't care if it's Vanguard, BlackRock, BetaShares. We want an exposure if it's the 200 or the 300, and then all you want to be focused on is how liquid is it? Can I easily trade in and out? And with these core strategies, it's fine. Each one has $1 billion, I think you've said anyway. Yeah, it's when you go into the smaller and different asset classes that you probably issuer matters more.
Yeah. How about then if it's a new issuer, but they've issued an ETF in Australia, but they don't have, this is their first ETF in Australia, and it's a good liquidity profile. It's just like a standard ASX thing. Like I imagine someone comes out and they're like, we're going to do the Australian ASX 200 for 1 basis point. Like, does the issuer play a bigger part there?
Yeah, I think so.
Yeah.
Because every chance that thing doesn't exist in 3 or 4 years at 1 basis point. Depends how much money they've got to lose for the next 5 years while they get to scale at 1 basis point.
Yeah.
But, I mean, even in the case, we've seen that ETFs close down. I think Vanguard closed one down a few weeks ago.
Russell last year.
And the Global Active.
UBS.
But it's just standard it's normal process. You don't lose anything. You just get shares are sold and you get your money back. So I think it matters then if it's new and if it's got scale or liquidity, and then who it's partnering with is always important. Do they partner with good market makers? Is there always someone supporting?
Yeah. Question for you then. Sorry, I'm taking this on a tangent multiple times, but for the ETF market makers, so the firms behind the scenes that are delivering units and doing creations and redemptions and whatever, we don't have to go into it now because there was a whole podcast on this, but how much attention do you pay to that? Like, do you think a lot about that when it comes to maybe not so much equities, but other types of markets like foreign markets where they've got to invest across currencies and so on and so forth? Like, how do you get comfortable with that?
Yeah, definitely. And if we're trading, we trade in-house. So if we're trading a lot, we have to have a relationship with market makers. If there's less volume, even trading preference shares, there can be less volume. So being able to call someone on the other side, confirm price, and then trade it appropriately. You could lose 1% by not getting the right price in a less liquid ETF if you're not making the call. But that's obviously at the smaller end. Yeah,
makes sense. Okay, great. So we've covered all of the major ETFs. You talked about like how you allocate fee loads and budgets across the portfolios, why you have 2 different variations, but they're kind of coming becoming one at Wattle Partners.
Yep.
You said that you like the ASX 200 because it removes that kind of 2 to 300, which is pretty small. I like VAS probably now, given that the fee load is comparable with the A200 ETF. We also talked about VHY. Maybe we can do a separate podcast on that because it is very, very popular for the income-seeking crowd and people that care about the total return. It doesn't really matter how it comes to you. Do you prefer income or do you prefer growth?
Yeah.
So, Drew, Meredith from Wattle Partners, it's always a pleasure. Thanks for doing this first episode in person, mate.
Thanks again.